Welcome to another tutorial video in our channel. This time around, we're going to be talking about a trend that has been in the news quite a lot lately, which is negative interest rates and negative yields on bonds, and possibly the next financial crisis. In other words, everything that was missing from your fixed income textbook or class. And since we are talking about a crisis, I thought it was quite appropriate to make this a Thanos-themed presentation. So if you've been paying attention at all to the news, you've probably seen a lot of headlines about negative yielding debt, which, as I record this, is now nearly $20 trillion worldwide. I have some of the graphs that have been seen in these articles, and it's not just with sovereign bonds, government debt, but as you can see in this corporate bonds graph, many corporate bonds, including even junk bonds, are trading with negative yields. So what is the deal with negative interest rates and negative yields? I'm going to warn you in advance that this tutorial is more opinion-based than some of the others here. We do go into Excel and I show you some calculations there, but mostly we're explaining a market trend and then I'm giving my views on it. It also gets into somewhat conspiratorial territory, so if you don't like that, stay away. If you just want something about an accounting rule or how to set up a DCF or something like that, we have plenty of others on those. This one is definitely more opinion-based, and if you're not into that, do not watch it. The short answer to this question can be summarized as central banks gone wild. Negative interest rates make no economic sense, and they have a terrible impact on banks, consumers, and anyone with a lick of common sense. Negative yields on bonds are also foolish, but sometimes you can come up with a quasi-rational explanation for them. The fundamental problem with both of these concepts, though, negative interest rates or negative coupon rates and then negative yields, is that they misprice risk, which leads to asset bubbles, unproductive investments, and also no real economic benefit for the average middle-income person out there. None of this is natural, despite how central banks try to spin it. They point to things like a glut in savings or demographic trends or things like that, but the reality is that negative interest rates and negative yields are the direct result of central bank manipulation in the markets, and specifically using tactics to artificially push down interest rates and keep them much lower than they should actually be in an honest financial system. So in this tutorial, we will cover four main topics. First, I'll explain why some people who are not, in fact, insane actually might want to invest in bonds with negative yields and even bonds with negative coupon rates. Then in part two, I'll give my views on why central banks are doing this and suppressing interest rates so much. Then in part three, I'll give my views on the endgame here and how everything is likely to end, which is not very well, as you'll see. And then in part four, I'm not going to call this investment advice because I would get in legal trouble, but I will explain what I am doing personally to avoid or reduce some of the upcoming damage from these policies. Let's go to part one and talk about why you would buy a negative yielding bond. The first thing to note here is that with bonds, the coupon rate, then prevailing interest rates, and then the yield on the bond are all different things, and most news sources and articles mix these up, or they don't understand the difference, or they just fail to acknowledge these differences. The coupon rate is the rate that a corporate or government bond pays. This is usually fixed, although it can be floating. So this might be something like 3% or 5% per year. So if you buy a bond for $1,000, you get 3% on it, you will get 30 per year, for example. Interest rates usually refer to the rates that banks charge to lend to one another. So in the US, for example, it would be the federal funds rate. Central banks set these, and right now they are set to very low numbers, 0, sometimes negative. And these are simply determined from above by central banks. With yields, there are different types of yields, but we'll assume here that yield means yield to maturity. So in other words, the internal rate of return if you buy a bond and hold it to maturity. So the difference between coupon rates and yields is that yields also factor in the price that you buy the bond at, and then what you get for it upon redemption when the company has to repay it or refinance and then use the proceeds to repay the bondholders. What this means is that you can have a bond with a negative coupon rate that has a positive yield, or you can have a bond with a positive coupon rate that has a negative yield, or virtually any other combination. Let's go into Excel and see how this works. So I have up here a simple projection with interest and principal repayments for a bond. Right now, I'm saying that we buy the bond for 1,000, its par value is 1,000, and then we get back that full 1,000 in 5 years when the bond matures. I'm saying right now that its coupon rate is 1% and the yield on similar bonds in the market is 1%. We can use the IRR function in Excel in addition to the yield function to calculate the IRR when we have the cash flows projected like this. So let's just do that. And then we can also, instead of just relying on the price function in Excel to calculate the bond's price, we can use the NPV function to calculate the present value, and we can use the market yields on similar bonds, and then the cash flows shown right here to do this. So now let's start messing around with this and see what happens. Let's keep the coupon rate at 1% for now, but let's say the price trades up, and let's say the bond starts trading at 110% of par value. So now we have a negative yield. The bond offers this 1% coupon rate, so we get positive interest on it, but since it is more expensive than what we get back at the end by a certain percentage, 10% here, we actually get a negative yield on the bond. Now, if we take the opposite scenario, let's say that we have a bond that has a coupon rate of negative 1%. You can see the yield function in Excel doesn't even work. The price function also doesn't work. But let's say, for example, that despite this negative 1% coupon rate, maybe it starts trading at less than its par value. So it starts trading at 95% of par value. And maybe it goes down to 90%. So in this case, the internal rate of return, or the yield on the bond, is 1.1%, even though the bond's coupon rate is negative 1%. Now, if you're looking at this and saying, okay, but how could this really happen? Why would a bond with a negative coupon rate be trading at less than its par value? The answer is very simple. If market yields on similar bonds are significantly higher, 1% instead of negative 1%, then sure, the bond price could easily go down to 900. If we calculate it manually in Excel, it comes out to around 903. So the point of all this is just to illustrate that there's a difference between these concepts, and a lot of sources conflate it or mix them up or don't even acknowledge what the difference is. With negative coupon rates, it's really hard to justify this, why you would ever buy a bond and then lose money in between. But with negative yields, since you could potentially earn positive interest in between, it might be a little bit easier to justify in some circumstances. So what's been happening in real life is that countries like Germany and Switzerland have been issuing zero coupon bonds where the market price simply gets bid up, resulting in a negative yield. The bond price equals the present value of future cash flows from bonds. So it depends on the purchase date or the settlement date, the maturity date, the coupon rate, prevailing yields on similar bonds, the redemption value, the payment frequency, and so on. What's been happening here, for example, is that a lot of these countries have been issuing bonds for a 0% coupon rate, and maybe the bonds mature in 10 years. And then what happens is that these bond prices get bid up. And so initially, they might be trading at 100% of par value, but then they get bid up to 105, and then to 110, and then to 115. And so the yield keeps becoming more negative because we don't even get any interest in between, and then we have to buy it at a higher price and then get back a much lower amount in the future. So this is sort of what's been happening in real life with some of these negative yielding sovereign bonds. The important thing to note, though, as well, is that bond yields and prices move inversely. So if yields turn negative, prices shoot up. But it also works the other way, where if bond prices get bid up, that in itself can make yields negative. So we have a two-way relationship here where prevailing market yields influence prices, but then prices also determine what the yield of the bond that you own is. Now, Excel's price function doesn't even work with negative market yields, but we can calculate the price manually in Excel. So let's see how this works. Let's say the bond initially trades at 100% of par value. It has a coupon rate of 0%, and so if market yields on similar bonds are 1%, then this bond's price should be around 905. But if yields start dropping, and let's say they go down to 0%, well, now this bond's current price of 1,000 seems reasonable. If yields drop again, and they go down to negative 1%, now this bond is worth over 1,100. And if yields keep dropping and they go down to negative 3%, now this bond is worth around 1,400. So investors might buy a negative yielding bond if they believe that overall interest rates and therefore market yields will fall even more so that they can sell the bond at a higher price in the future. And that's really all it comes down to. No one in their right mind is going to buy a negative yielding bond and plan to hold it to maturity. they're going to buy it, they'll bet that yields will fall even more, pushing up prices, and then they plan to sell the bond in the future to earn a return as these yields keep falling. And by the way, this applies whether the coupon rate itself on the bond is negative, positive, or zero, because as you saw before, this scenario can happen regardless of what the coupon rate on the bond and the actual interest that you earn on the bond is. So traditional bond investing is supposed to be about earning modest interest income with some possibility of capital appreciation, depending on the direction of interest rates, the company or government's credit quality, and so on. But negative rates and negative yields turn bond investing into a casino where the buyer is always waiting for the greater fool. In other words, waiting for those prevailing market yields to drop because central banks are setting interest rates so low. And the longer the maturity of the bond, the more sensitive its price is to small changes in market yields. For a good example of this, let's go back into Excel and let's look at a wide range of scenarios here. Let's say that the prevailing market yields on similar bonds can range all the way from 0% down to around negative 8%. And let's set up our sensitivity table. For the bond maturity, I'll set this to the bond maturity cell. And then for the market yield, I'll go up to the market yields on similar bonds cell. And we refresh our table and we can see it right here. As you go further out, there is a bigger and bigger price increase here. So a bond that matures in 10 years, when yields suddenly become negative, its price is going to go up by a whole lot more than a bond that only matures in, say, 1 year or 2 years or 3 years or something like that. If you don't believe me and you want to see a good example of this, take a look at the 100-year Austrian government bond that was issued in 2017 and its price movement since then. Here's what the graph looks like. Now, anytime you look at a graph like this, you really have to ask yourself if the world is being rational at all or if a giant bubble is building. So it's gone up 70% this year. It's now trading at over 200% of par value as of August 2019. Now, these bonds still have a low but positive yield, but since they mature in 100 years, their duration and convexity, the first derivative and second derivative of bonds with respect to prevailing market yields, are very high, making them extremely sensitive to small changes in those market yields. And that's exactly what's happened. As market yields have gone down, the prices on these have just gone up and up and up, and more people have gone in an attempt to capture some of that price appreciation. Let's go into part 2 now and talk about what central banks here might be thinking. The short answer is I don't think they're really thinking at all, because Japan has experimented with quantitative easing, super low interest rates, negative rates for over 20 years, and none of it has worked or improved their economy at all. My guess is that central bankers think that since cutting interest rates when they're positive is supposed to stimulate the economy, the same will work when interest rates turn to zero or negative. And they especially think this in regions like Europe with extremely low growth. Their logic is that if you make rates negative so that people start losing money by depositing it in the bank, then those people will have to spend it on something, and so they'll stimulate demand by doing that. Also, I would note that many governments and companies have racked up massive debt balances that would be impossible to service if interest rates were honest. So I think it is very plausible that central banks are doing this because they know that governments and companies in their countries have no chance to actually repay or service their debt if interest rates were higher. The problem with all this is that offering negative rates doesn't really encourage people to spend. It just encourages them to take their money out of the bank or to chase yield with extremely risky assets. Just look at some of the articles and headlines on this topic if you want examples. I'm not spending much more money and I'm not saving much more money. I'm just moving it around. In Switzerland, some individuals are putting cash into real estate. Holding cash is simply more expensive than building an empty house. Sweden was one of the first countries to go negative with interest rates, and it hasn't had its intended effect at all. You can see right here in this graph from a Wall Street Journal article that the savings rate hasn't really changed in these countries like Switzerland and Sweden with negative rates. And then it says right here, negative rates have failed to spur spending durably and stimulate growth and inflation across Europe. So clearly it's not working, and we really have to question why central banks are doing this at all. Negative rates also crush private commercial banks because negative rates make it harder to earn net interest income, and they also encourage banks to chase yield by investing in riskier assets. They also allow zombie companies that shouldn't exist to continue to exist and to keep tricking investors into plowing money into them. The prime examples being WeWork and Uber, which we looked at earlier this year in evaluation. So that takes us into part 3, which is what the endgame here is. So we'll go back to Thanos for this one, since he seems to be an expert at destroying half of all life in the universe. The simple answer is that if you hold a bond with a negative yield to maturity, you lose money, so no one really intends to do that. As I said before, it's all about a quick flip and trying to realize some quick capital gains. But you should also note that you lose money if prevailing yields on similar bonds suddenly rise, pushing down the price of the bond. And many things could cause that. There could be a huge sell-off in the bond market, something else could force interest rates back up, there could be an economic recovery, there could be higher inflation, there could be a sovereign debt crisis, and so on and so forth. You can see it pretty well in this table here. If market yields suddenly went back up to, say, 4 or 5%, you can see what happens. In that scenario, the price of a bond with a 0 coupon rate and, say, a 10-year maturity would instantly fall by 30%, 40%, maybe even more than that depending on the terms. And of course, if it actually offers, say, a negative coupon rate, it's going to fall by even more. You could be looking at a 50% loss in that case. So my prediction is that there will, in fact, be a massive correction in the bond market that causes prices to fall back to earth. I don't know when, and I don't know what or why, but at some point, there will no longer be people standing around waiting to buy negative yields, betting on even lower yields. And you already saw this with the failure of the recent German auction of around $2 billion in government bonds, where they couldn't sell even close to what they were expecting to sell to investors. So I think the likely outcomes here are possibly another European debt crisis, maybe a worldwide currency or inflation crisis, or something like that. If you're asking about what to do, again, I have to give the short disclaimer, this is not investment advice. Don't just mindlessly follow this. These are my own personal views. My strategy is to stay away from all bonds except for US Treasuries and US-based municipal bonds, and both of these do still have low but positive yields. I'm very skeptical of all corporate bonds worldwide. We didn't even get into it, but I think there is a ton of credit risk there. And as soon as something goes wrong, a lot of companies are going to find themselves in serious trouble with leverage. I'm also very skeptical of all this negative yielding European and Japanese debt, so I'm staying far, far away from that. If you look at my overall portfolio allocation in one of my main brokerage accounts right now, I have a pretty low equities allocation, around 40% of the total, a pretty high allocation to cash, US Treasuries and municipal bonds, around 40%, and then around 20% in gold, traditionally viewed as a safe asset and something investors flock to when there are fears of inflation or crises or other bad things happening in the world. Interestingly, gold has actually been my top performer year to date when I switched allocations earlier this year and started doing this. I'm not suggesting that you do this. This is just personally what I'm doing in light of these events. Let's do a quick recap and summary now. So we went over why some people who are not insane might invest in bonds with negative yields and even negative coupon rates. In short, they know that if they hold it to maturity, they're going to lose money. So they're doing it because they think that prices will rise even more, meaning yields will drop even more, and they can resell it for a quick flip and gain something like that. Central banks are doing this because they have this misguided belief that negative rates and negative yields will cause people to spend money and buy more TVs or furniture or something like that. But in reality, it's not doing that at all. All it's doing is causing people to chase yield or to move their money around to different accounts in search of yield, or maybe to withdraw their money from banks altogether and put it under the mattress. I think there is going to be a massive correction in the bond market, which is why I am largely staying away from bonds except for, as I mentioned, US Treasuries and positive yielding US-based municipal bonds. So that's it for this lesson. I realize this was more opinion-based than many of the other tutorials in this channel, but this is a big trend that we've been getting a lot of questions about, so I wanted to cover it here, explain why it's happening, and then give my views on it.